home right now, there's a very good chance you're sitting on a massive amount of equity and most people have no idea how to use it. Or worse, they use it the wrong way. Byron here. Today we're talking about HELOCs. If you like straight to the point content like this, hit the like button, subscribe, and turn on notifications so you don't miss the next one. Right now, across the country, homeowners are sitting on record levels of equity, meaning your house is worth more, you owe less, and that gap in between, that's usable money. So the question becomes, how do you actually access that equity? There are two main ways. You can refinance your first mortgage and take cash out, or a home equity loan, often referred to as a HELOC. And today I'm going to break down both in plain English, so you know which one actually makes sense for you. Let's start with the most popular option right now, a HELOC. That stands for Home Equity Line of Credit. The easiest way to think about this, it works like a credit card, but it's backed by your house. You get approved for a limit, let's say $100,000. You don't have to use it all. You can take money out when you need it and pay it back when you don't. Now here's what makes HELOCs different. Number one, they are variable rate loans, meaning the rate moves with the market. So when you hear the Fed is raising rates, your HELOC rates go up. When rates drop, your HELOC rates can come down as well. Number two, they are usually interest-only payments for the first 10 years. This is huge because it keeps your monthly payment low. Number three, there's something called a draw period, usually 10 years. During that time, you can pull money out, pay it back, use it again, over and over. After that, you enter repayment, typically another 20 years. HELOCs are great if you want flexibility, you don't need all the money up front, you want a lower initial payment, or your income fluctuates. So that's a HELOC. Flexible, interest-only options, but the rate can move on you. Now let's talk about another option. And this is where a lot of people get it wrong. A refinance is completely different. You're not adding a second loan. You're replacing your current mortgage with a brand new one. So instead of having your first mortgage plus a HELOC, you only have one loan. Think of it like hitting reset on your mortgage. New rate, new payment, new term. And depending on how you structure it, this can either help you a lot or cost you if you're not careful. With a refinance, you can choose a fixed rate, which stays the same, or an adjustable rate, which is a lower upfront, but can change later. And just like your current mortgage, this is principal and interest. So unlike a HELOC, you're paying the balance down immediately. When you refinance, you usually reset your loan term. So you've been paying your mortgage for 5 years, and you go into a 30-year loan, you just started over. This is usually the better move if you can significantly lower your interest rate, you want one clean payment instead of two, you want to consolidate debt, or you want to pull a larger amount of equity out up front. Because with a HELOC, you're adding a second payment. With a refinance, everything is rolled into one payment. Now, most people think rates dropped, I should refinance. That's not always true. You have to look at closing costs, your break-even point, and how long you're looking to stay in the home. If it costs you thousands to refinance and you're not staying long enough to benefit, you actually lose money. For a refinance to make sense, you typically want enough equity. Most strong options are at 80% loan to value or lower. The more equity you have, the better this works. So let's simplify this. A HELOC, flexible, lower payment up front, variable rate, you can use the money as needed. With a refinance, it's one loan, fixed rate or adjustable, it resets your term, and can lower payment or pull cash out. Here's the easiest way to think about it. If you need flexibility, go with a HELOC. You want structure and simplicity, go with a refinance. When used correctly, both of these are powerful tools. When used incorrectly, you're just stacking debt. If you're in Rhode Island, Massachusetts, or Florida, and you want to see what your equity looks like, or whether a HELOC or a refinance actually makes sense, reach out. I'll walk you through it, no pressure, just real numbers. Because most people are sitting on an opportunity right now, don't even realize it.